let's get into your pro picks, your top ideas for US stocks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right. Now, this is my favorite part of the show where you tell us your favorite ideas. And we started off by talking about, okay, why is the U.S. government buying all these stocks? And you mentioned it has to do with national security. And so it is important to understand what are the strategic imperatives of the U.S. government right now? How can you apply that to your portfolio? And I think a lot of these names, you like them for different reasons, but is that one of the themes as well? Help me understand before we dig into each.
Absolutely. It's really not just national security, but a Trump trade or Trump administration advantage. One thing I find extraordinarily remarkable, I mentioned that I'm in Silicon Valley right now, is that traditionally Silicon Valley has been extraordinarily liberal. Well, it really took the Biden administration to convert them to being Republicans. And the reason for that is they don't really mind paying higher taxes. And by the way, it's mostly capital gains, so they're happy to have other people pay higher taxes. But one thing they absolutely cannot stand is not being able to sell their companies. Mm-hmm. So if you can't do M&A, then there's less IPOs as well. That is absolutely horrible for private equity firms. And so you saw a lot of those management teams really flip over to the Republicans, start giving heavy money to the Trump campaign at the time. And so now you're seeing the flip side of that play out, that the merger environment is now, it's probably not loose, but it's just normal. So you have to actually be creating monopoly to ban a merger. And that means that companies that are levered to mergers and IPOs and deregulation, particularly financials, not necessarily the regionals, but the riskier investment banks and private equity firms, are going to do well. So I do think that was kind of an obvious, thing to be, but those companies have been running because it's just a great environment to be an investment bank, or even better to be a private equity firm, because you get realizations, you get fees, and then your clients have more money to invest in your other funds.
So the first two ideas, it's kind of a two for one, is KKR and Apollo. And it sounds like those play right into that wheelhouse. But, I got to say, KKR, Apollo, well, definitely KKR hasn't done super well, and neither has Apollo, quite frankly. They're both down 20% in 2025. So help explain that disconnect where you see these bullish factors, but the stocks aren't performing.
No doubt these are well-hated stocks. They're kind of the opposite of they're momentum, but downside momentum stocks. But we think it gets back to what we were talking about before, irrational fears about a systemic credit problem. But what we love about the private equity firms, because you could argue about the banks, and maybe there'd be more write-offs, but the private equity firms have higher quality portfolios, so much less likely to have a problem. And Apollo just reported this morning and verified that they have high quality credits. And then, not that they want to lose their clients' money, but it's not even their capital. So if they did lose money, they would be good because their clients might not be happy. But it's not like a bank where they just write off equity. So they're kind of 2 or 3 steps removed. In the case of KKR, they didn't even have a lot of asset-based financing. So we do think valuation matters. So for instance, we've been recommending Amazon for a while. Horrible, horrible stock up until last week. And same thing, Apollo, terrible idea up until this morning. So when reality hits and you have a super cheap stock and actually you're correct that their fundamentals are good, you get these big outsized returns. So for both of those stocks, we have targets. So KKR is about 120-ish. We have a 200 target, which might seem ridiculous, These are really, really good companies, great companies, arguably, in the case of KKR, the best financial services brand name in the world. So when they go on sale, you just need to buy them. You can close your eyes, do like my daughter did, look at it in
30
20
years.
years, and it'll be up, a ridiculous amount.
So that's a 70% upside. I did the math for everybody on KKR. I assume the same is kind of similar return profile for Apollo.
Correct. Yes.
Now,
It's really, really, these are really, really cheap stocks, but they're great business models.
you mentioned Amazon, and that's actually your second idea. And you're right. It kind of did go nowhere. And it's interesting you mentioned M&A and deals were not able to be done. They were trying to buy the Roomba maker. It was called iRobot. Mm-hmm. And now, iRobot's just probably going to go bankrupt because they weren't able to find a buyer. So I don't think that's why you like Amazon, because now you think they'll do the robot deal. But what attracted you to it? And now that earnings are out and people have rediscovered Amazon, where do you think it can go from here?
Well, it's really two elements. The first is they did have slightly disappointing AWS revenue, so their cloud revenue is only growing at 18, still pretty good. And we think people overreacted to that. And what they're missing is that Amazon has this, as we all know, or at least if you live in an apartment complex, because every day the concierge is overwhelmed with Amazon packages. They have this fantastic retail business that they make very little money from, but they have new professional management. So not the founder, Andy Jassy. He's focused on making that more profitable. They recently cut corporate overhead. They're increasingly implementing robots. They're moving inventory closer to the end markets, saving on costs. They're advertising. So we think that's the big story. But what got the stock moving was AWS accelerated to 20%. We think they'll continue to do well, but they are the incumbent. So it's they can't grow at 40 like Microsoft. But that business is good to great. And then you have this cost cutting story. Yeah, so with Amazon, we have a 300 target and it's trading at 250. So still about 20% upside. But we had that target when they were at 220 as well. Mm-hmm. So the targets do matter. And they do show earnings is always risky. But if you have a very cheap stock going into earnings, it tends to skew the risk reward into your favor. No guarantees. But there's still upside in that stock, unlike a lot of the other large cap tech stocks.
The third pick is a large cap tech stock. It's Marvell. That's fallen out of favor. It's down 20% this year. Why has it fallen out of favor, and why do you like it here?
So in another example where we do look at valuation, what happened with Marvell is they reported earnings were pretty much in line last quarter, but they didn't give bullish guidance. The stock got completely smashed, went down to as low as about 65. But later, the CEO clarified, so the following week, that they were being conservative because they didn't want to give away proprietary information of their major customers. And these are major with a capital M. So these are all the big tech companies. And so they tried to clarify that. So it's in the transcript. You can go read that. And then just to validate that, they announced a share repurchase, insider purchases. Stock ran up to 90, which is roughly where it's trading now. But we still have 120 target, and it was at 120 prior to them announcing earnings. So we think a reasonable target. We do think they're going to do well when they report. No guarantees, obviously always risky going into reports. But we think there was excessive pessimism about their backlog that really just came from them trying to be loyal to their customers and not reveal all their plans. Because keep in mind, these are very close relationships. They design the chips for specific companies. So there's a proprietary relationship there. So we think actually that'll help them by being conservative. And unlike their competitor, Broadcom, they're trading at a very reasonable PEG ratio or ratio of PE to growth.
Jay, an absolute pleasure. Thank you so much for joining us. We learned a lot.